The biotech VC market has completed a full boom-bust reset cycle since 2012, and we've thus seen unprecedented capital inflows into the asset class, a sharp correction, and now an emerging recalibration. What are the key takeaways? How should investors adapt? And what does this mean for future returns? We analyze these questions and more in this video. Top-performing funds have specialized in biotech. They deliver around 20% plus net IRR over the past decade, while generalist VC underperformed. Regional shifts accelerated with challenger hubs like China, Singapore, and Israel gaining share against US and EU incumbents. Capital concentration intensified with mega funds, those greater than $500 million, dominating late-stage deals, and small funds, those less than $100 million, leading early innovation. Looking ahead, we think a rebound in M&A, AI-driven drug discovery, and selective geographic expansion will define the next cycle. To help frame our outlook, here's a quick look at how we got here. First, the boom from 2012 to 2021, breakthroughs in mRNA and gene editing, low interest rates, and an IPO frenzy, with over 150 biotech IPOs in 2021 drove extraordinary capital inflows. Over $100 billion was deployed across 15,000 deals. With over 70% concentrated in the US and EU, valuations surged with pre-money valuations peaking at 3 to 5 times 2015 levels. Then the bust from 2022 to 2023, rising rates, inflation, and an increasing number of clinical trial failures triggered a roughly 40% drop in funding. The IPO window collapsed and M&A became the primary liquidity path. Late-stage companies saw valuations reset by 30 to 50%. And now the reset through 2024 and beyond. We're seeing a new investment thesis emerge focused on capital efficiency, platform-based models, and a later-stage bias. A resurgence in crossover rounds signals this shift. 2020 foresaw an uptick in private placements of $100 million or more. These are typically used to extend company runways and to risk prior to IPO or sale. At the regional level, we're seeing the rise of challenger hubs. While the US and EU remain important, their share of early-stage deals has declined. Boston and San Francisco accounted for 65% of deals in 2012 to 2018 compared to 55% in 2019 to 2024. We expect this trend to continue, with 30% of early-stage deals by 2026 originating in Asia and Israel. This forces US funds to decentralize or risk missing out on the next wave of innovation. In terms of fund size, we see 3 different trends playing out. Megafunds greater than $500 million dominated late-stage deals in the boom years, but they lines likely consolidate with fewer players by 2025. Mid-tier funds $100 million to $500 million struggled during the bust, and those that survived have pivoted to niche therapeutic focus areas like neurology or rare diseases. Small funds less than $100 million are leading the way on early-stage deals, and we expect this trend to continue, with 50% of seed deals in 2027 driven by funds of this size. In particular, we think small funds will leverage academic spinouts and AI tools to source and structure deals. From a performance perspective, biotech VC has outperformed generalist VC by 5 to 6% over the past decade. This is driven by what we call the specialization premium, deep scientific engagement, and concentrated portfolios. Conversely, we think generalist LPs may overcorrect and flood biotech with indiscriminate capital by 2025. Over time, we think the pendulum will swing back as tourist capital tends to follow the headlines. This leaves an opportunity for funds that double down on specialization, avoid crowded spaces, and build deep benches of PhD scientists. Looking ahead, there are 3 strategic imperatives for investors. First, distressed assets from 2022 and 2023 vintage will likely offer 3 to 5x returns by 2030. However, increased FDA scrutiny, including reforms to accelerated approval pathways, could delay exits. Second, funds that integrate AI into their investment thesis will win. This includes machine learning-driven drug discovery and cell and gene therapies. Funds that co-invest in China and Israel will also benefit from lower cost R&D and larger addressable markets. Finally, funds that align interests with LPs via hybrid evergreen plus traditional VC structures should thrive. On a 2025 timeframe, we expect an M&A wave fueled by big pharma's $1 trillion plus cash reserves. From 2026 to 2027, a secondary market will likely emerge for stranded pre-IPO assets. And any hopes for a new IPO window will depend on interest rate cuts. In conclusion, the reset phase is a buying opportunity. Companies built in 2022 and 2023 will be well below 2019 and 2020 valuations. And disciplined capital will be able to capture the next wave of innovation. If you enjoyed this content, please subscribe to receive our monthly newsletter and other updates. Thanks for watching.